Number 1. 1825, the first global crash. Our journey begins in 1825 when the British Empire believed it was entering an age of endless prosperity. Credit flowed freely, banks grew bold, and investors chased dazzling opportunities in newly independent South American nations. Pamphlets promised gold mines, thriving ports, and modern cities, even when many projects barely existed. Speculation spread like wildfire, turning ordinary citizens into confident gamblers. Yet beneath the excitement, the system was dangerously unbalanced. When a few key institutions collapsed, fear exploded. Banks failed, loans vanished, and entire communities watched their savings disappear almost overnight. The crash delivered the world's first clear warning about the cost of unchecked optimism. Number 2. 1873, the Long Depression. The downturn of 1873 began with enormous faith in railroads, which people believed would reshape entire nations. Investors across Europe and the United States poured money into new lines, convinced that endless growth was guaranteed. Companies borrowed aggressively, expanded too quickly, and ignored early signs that profits weren't keeping up. When a major Austrian bank collapsed, panic spread instantly across global markets. Stock prices plunged, factories shut down, and unemployment climbed for years. What made this recession unforgettable wasn't the initial shock, but the slow, exhausting decline that followed. The world slipped into a 20-year malaise that revealed how fragile progress becomes when built on unchecked speculation. Number 3. 1929, the Great Depression. By 1929, many people were convinced prosperity had become permanent. Rising wages, cheap credit, and soaring stock prices made the market feel like a stairway that only went up. Investors borrowed heavily to buy shares, certain they could only win. Yet stock values drifted far beyond the real strength of the companies beneath them. When confidence finally cracked, the collapse was brutal and relentless. Banks failed, savings evaporated, businesses closed, farms were abandoned, and global trade unraveled. Millions lost jobs, homes, and any sense of security as governments struggled, argued, and slowly reinvented how modern economies should be managed, regulated, and protected from future disaster. The Great Depression marked a turning point in welfare systems, politics, and global finance. Number 4. 1973, when oil stopped the world. In 1973, the global economy was humming when a seemingly distant political decision flipped the switch. Several Middle Eastern oil producers cut supply, sending crude prices soaring almost overnight. Cheap fuel, the invisible engine behind transport, factories, and heating, suddenly became painfully expensive. Lines formed at gas stations, flights were cut, and governments scrambled for solutions. Inflation surged just as growth stalled, creating the nightmare mix later called stagflation. The shock forced governments and consumers to adapt quickly, sparking car-free days, efficiency pushes, and debates over energy independence. Number 5. 1980s, fighting inflation with pain. By the late 1970s, prices were out of control. Groceries, rent, fuel, everything seemed to get more expensive every month. People stopped trusting their own money. To break this spiral, central banks, led by the U.S. Federal Reserve, chose a brutal cure. They cranked interest rates to levels that felt almost insane. Overnight, loans became crushingly expensive. Mortgages failed, construction sites went silent, and factories closed as companies couldn't afford to borrow. Unemployment spiked, small businesses vanished, and protests grew louder. Yet slowly, inflation finally began to fall. This recession showed how far governments will go to defend a currency, even if it means sacrificing short-term comfort, growth, and stability for a chance at future control and deep personal anxiety. Number 6. 1997. The Asian financial crisis. In the mid-1990s, several Southeast Asian countries became global growth superstars. Skyscrapers rose, foreign capital poured in, and headlines praised an unstoppable Asian miracle. Behind the shine, banks were loaded with risky loans, governments defended fragile currency pegs, and debt quietly piled up. When investors panicked and rushed to pull money out, exchange rates collapsed in a brutal chain reaction. Thailand fell first, then Indonesia, South Korea, and others. Businesses died overnight, savings vanished, and millions were pushed into poverty. The crisis shattered faith in the miracle story and forced governments into hard reforms. It left a simple warning: growth built on foreign money, weak banks, and investors who can run at the first sign of fear is not strength at all. Number 7. 2008, the housing market meltdown. In the early 2000s, owning a home felt like a guaranteed win. Prices kept rising, banks handed out mortgages to almost anyone, and financial firms sliced those loans into complex products that even many experts barely understood. As long as prices climbed, everyone looked smart. But underneath, a huge share of borrowers couldn't really afford their loans. When interest rates rose and payments jumped, defaults spread.
House prices fell, then crashed. Suddenly, those safe financial products turned toxic. Banks teetered, giants collapsed, and credit froze. Millions lost homes and jobs. The 2008 crisis exposed how dangerous it is when an entire system bets on the idea that nothing can ever go wrong. Number 8, 2020, the fastest recession in history. In 2020, the world entered a recession unlike anything seen before. It didn't start with bank failures or a stock bubble, but with a sudden global shutdown. Borders closed, streets emptied, and entire industries, from airlines and tourism to restaurants and events, froze within days. Economic activity plunged at record speed. Governments launched huge rescue packages, sending trillions to companies and households just to keep cash moving. The shock exposed how dependent we are on constant motion and confidence, leaving scars beyond charts. Shuttered small businesses, delayed plans, anxious workers, and a new awareness of how fragile normal really is.